We're diving into the world of personal finance and some of the unusual terms that get thrown around as if everyone knows what they mean. Today we're breaking down something called a bull market. Now, I know it might sound like we're talking about a rodeo, but we're going to stay on it longer than 8 seconds. So, what is a bull market, and where did this term come from? The somewhat official definition of a bull market is when stock prices are up 20% from the recent lows. At least that's what the Wall Street and TV pundits proclaim. It's generally considered to be a time of rising prices. For investing purposes, we're talking about stocks, but it could be anything that's traded: bonds, real estate, baseball cards. I think Novak Djokovic is his own bull market in tennis. Bull markets fuel a sense of optimism. Folks like seeing their investment values rise. They tend to buy more when stocks are rising. They don't want to miss out on all the good times. The euphoria feeds on itself. Everyone is feeling good and wants to get in the game. It's kind of like Powerball when the jackpot hits $1 billion. Everybody buys a ticket, as if a $50 million jackpot is beneath them. Where did this term bull market come from? One theory says a bull market describes the way a bull attacks its adversary, thrusting its horns upward, the same direction as rising stocks. I'm not sure I'm too bullish on that explanation, though. Yeah, if we're going to complete the equation, a bear apparently doesn't deliver uppercuts, but strikes its opponents in a downward fashion. So there you have it. A bull market is when the stock prices are charging up like a determined bull. It's a time of optimism, rising prices, and potential for investors to make some money. And the official Wall Street definition, when prices are up 20% from recent lows. I never like to get too caught up in whether we're in a bull or bear market. Buying low and selling high is still the key to making money. Bull markets feel good, but prices are usually lower in a bear market.